Let's now talk about United Health. United Health stock is down 42% year to date, over 44% over the last 12 months. Their Q1 balance sheet, let's just put it this way, it's not that desirable. I was actually surprised that a Dow 30 company does not have that desirable of a balance sheet. Take a look at this, and I'll hide myself so I don't cover up numbers here. All right, so on a liquid basis, they have $96 billion in current assets, but they have about $113 billion of bills to pay, which is a lot. They have to pay those bills over the next 12 months. Now, the company does generate about $20 billion of cash flow if you annualize out their Q1 2025 cash flow of about $5 billion, which means they would have just enough money to pay all of their bills. And so if you subtract their longer term debts from their longer term assets, they've got about $100 billion sitting around. So it kind of gives you the tangible value of this company. So think about it as they have net equity of $100 billion and they generate around $20 billion a year in cash flow, again, annualizing their Q1. They actually make a lot of money in that sense. So on their net equity, they're returning like 20% per year, which is phenomenal. Now, you are paying a premium for that business. Right now, you're not paying $100 for the business. You're actually paying about $264 billion for the business, which means you're paying about 8x their cash flows for the company. Now, sometimes what I like to do is I like to take their cash flow and divide it by their market cap. And that's also still pretty good. That's a 7.5% yield. That's not bad on sort of a free cash flow yield if they can keep this sort of annual cash flow going of 20 bill, $5 bill a quarter. Maybe they can't. And that's where the questions are. Because if we just annualize out Q1, it doesn't look that bad. Yes, their balance sheet isn't that perfect, but it's not uncommon for insurers to operate a little tight, and they've got the free cash flow if we can annualize Q1. If we have to annualize Q1 of last year, it ain't that good because they're only clearing like $1 to $2 billion in free cash flow. It's not as good. That said, the insurance business is a very low margin business. Their Optum, I guess it actually is. It's not Optimum, it's Optum. But anyway, their Optum services business, where they provide services for pharmaceuticals and to doctors and others, only has an operating margin of somewhere between 5.8 to 7.4%, depending on which quarter you're looking at. And the actual healthcare business only has margins of between 4% to 6.2%. It's a low margin business. They pay out a lot of money. And so it kind of makes sense that they go around and try to find whatever loopholes they can to milk as much money as possible out of the system. But this is where the fraud allegations are coming up because they're doing things that are just wrong. And this leads people to say, why would you ever want to touch this business? Because a lot of people are looking at this as a buy the dip opportunity, but others are like, I just can't bring myself morally to invest in this business. That's what some say. Now, keep in mind, the CEO did just buy $25 million of stock and the CFO bought $5 million of stock. A lot of people see that as just signaling though, because you might not know this, but the CEO's stock package, $61 million. So it's kind of like he took a fraction of his entire pay and sort of like reinvested it back into the business to send a signal. And if you look at their income statement, they do pay out a lot of the premiums that they spend, which again contributes to these lower margins. They pay out about 84 to 85% of the premium dollars that they collect. So imagine you were an insurance company and you were collecting $100. You're paying out about $85 of that in premiums. It's kind of an interesting stat if you're ever thinking about insurance. And then they got a whole crap load of costs on top of that, obviously, because they have to deal with the government administration and people and all of the claims and underwriting and processing. It's dealing with the hospitals. It's kind of just a crap business. The margins are really, really low and their balance sheet is tight. Again, long term, they've got money, okay? And they produce cash flows. But it's a tight and dirty ship. Think about it like that. You know, it's not like they're selling iPhones at a 25% margin, right? Where they're bringing so much money down to the bottom line because they're selling you this beautiful app store wrapper as well. This is a tight and dirty ship. Now let's talk about the dirt. The Wall Street Journal did this like Pulitzer Prize winning expose on them. And I'm just going to give you the bottom line on this, okay? Let's say you're a health insurer and the government tells you, hey, you will get paid in lump sums for any Medicare Advantage patient you have that has a new diagnosis, okay? So imagine you're an insurance company and the government says, hey, if you insure those 10 people over there and they have no diagnoses, you get 0. But if each of them has one diagnosis, we'll give you $2,500 per person. If they have 2 diagnoses, we'll give you $5,000 a person. What incentive do you think that sloppy government assignment creates for United Health? Let's send nurses to every old person's home on Medicare Advantage for free house calls to see if you have any ailments. And that's exactly what they did. They hired nurses, sometimes to go to, conduct 6 house calls a day and basically hook up patients to random BS, diagnostic equipment to find out if the oxygen flow to your extremities, for example, like your big toe, is slightly below average, so we could diagnose you with some arcane illness that you don't even know you have no problems with. It's not like you're falling off your feet or whatever. You don't even realize you have a problem. But they're going to register that as a diagnosis so they can collect money from the government, meanwhile not actually pay anything for you. So the reports that the Wall Street Journal put out basically said for every house visit United Health made, they earned about $2,700 in revenue, $2,735. And they were the worst out of all of the different insurers. Humana at $1,525, CVS Aetna 300 or 232. Anyway, so you could see the desire to conduct a lot of home visits. United Health did the most and make lots of money off that. Now the cat's out of the bag and the federal government has said, look, we're not paying for some of these diagnoses anymore. You ripped off the system because now people have all these diagnoses that they didn't even know they had. Their doctors didn't even know they had. And they were never treated for, just so you can milk some free money. And so now, obviously, earnings for United Health are kind of in the toilet. They've withdrawn guidance because they're like, crap, we don't know how much of an impact this is going to have. All the good numbers we had were based on basically fraud. And now we got to pick up the pieces. So what pieces are left? Well, again, it's a business that on a free cash flow basis yields about 7.5%, on their market cap. So yeah, the dip is sizable. But again, you're getting into a legally fraught and now a hated business with terribly low margins. Look, is this a great buy the dip opportunity? For people who are just going to put any kind of morality on the shelf? Maybe. But look, I stay out of the insurance sector because it's complicated enough as is. And looking at this United Health stuff, I'm like, man, I scratched the surface and I'm like, this is a disgusting business. I'll pick any other business. So look, if you buy the dip and you make money on it, I'm happy for you. But I can't touch this kind of business with a 10-foot pole. And again, I'm not telling you not to. I'm just saying for me, man, it's not my world. I'll go stick to houses. Hey, quick reminder, if you want to earn a 5% yield plus all of the upside in my real estate startup, we are offering a non-accredited investor round where we will pay you a 5% yield plus you get all of the upside in the stock when your stock converts in the future. It gives you an opportunity to diversify away from rich stock market valuations, diversify away from most tariff risk, diversify away from the craziness of the treasuries market, especially with these Moody's downgrades. You diversify into fixer-upper real estate, which is what I believe I do best. This is my baby. I call it my little Berkshire Hathaway. Now, maybe I'm biased, but I've got over $5 million of my own money invested into this business, and I'm so excited for what I think we're going to be able to do with this business over not just the next years, but the next decades. So if you want to invest in my real estate startup, go to househack.com and know that I will do everything for this business in my power to make sure we can do the absolute best that we can. Make sure to read the solicitations and disclosures on the HouseHack website because there is risk with every investment.